100 right now. Watching the price of gold, the metal right now, one of the few winners amid the sell-off yesterday. It has looked like a place to hide in this sell-off. The highest level yesterday in a week, and it could be a sign that the fear trade is back. Joining me right now is the author of The Death of Money, Jim Rickards, joining us. Jim, good to see you.
Good morning, Maria.
The Death of Money sounds very scary to me. Tell me about the title of this book.
Well, when I say the death of money, I'm talking about really loss of confidence in paper currencies. And this has happened multiple times in the last 100 years, 1917, 1939, 1971. You know, in the late 70s, the U.S. issued bonds denominated in Swiss francs because nobody wanted dollars. Those were the famous Carter bonds. So it does happen every now and then.
Do you recommend buying gold as a place to hide, a place for safety in this environment where stocks have been selling off?
I definitely do. For a long time, I've recommended about 10% gold. Don't go all in, don't go half. It's being 10%. It's kind of insurance. It's like fire insurance on your house. Nobody wants their house to burn down, but heaven forbid if it does, you're glad you have the insurance. So have a slice of gold along with, you know, stocks and bonds and cash and other assets.
Jack, would you like gold?
I'm not a big gold fan. I think there's nothing wrong with allocating a portion of your portfolio. I'd cut that 10 in half and say 5. And the important thing is I don't think people should. Gold has this luster, obviously, and people think, well, it's been around forever, and so I'll put all my money in it. And that's it. And then people use scare tactics to say you got to buy gold. And I don't like that, but I don't mind as an allocation, as a hedge, because it does zig when stocks zag.
And I don't know of an insurance plan that's lost, maybe if you bought at the peak, 40% of my money.
Well, you write a check to the insurance company every month, and if your house doesn't burn down, that's lost money, but you're glad you do it because that's your hedge. As far as gold is concerned, you know, people say it has no yield. Take a dollar bill out of your purse or wallet and look at it. It has no yield. If you want yield, you have to take
But that's
risk.
not the only alternative to gold, though. An alternative would be anything that has income, that produces income, whether it's a treasury or a bond or
right,
even
but your
a stock.
income's in dollars. If people lose confidence in dollars, and your income goes away, that's the problem.
Yeah, but your whole argument's predicated that all these currencies are all going to go bust at the same time.
Well, that's what happens. I mean, it's not an argument, Dagan. It's 5,000 years of history.
Not in modern history, it's not.
Well,
not in modern history,
if you use very short time zones, yes. But if you look at a longer time, including 100 years.
In my lifetime, is it going to happen? So you're predicting that these fiat currencies are all going to go boom.
Well, you said from 1999, gold is up 400%.
Sure.
Right. That's the reason not to buy it, actually.
Right, exactly. And you go back to the 70s, it's up, you know, a couple %. So, but the point is, when people say gold is up, I don't really think of it as up. What I think is the dollar is down. In other words, you get you get less gold for your dollar, so the dollar is really down. If gold went to $10,000 an ounce, which I do expect, I wouldn't think of it as a rise of gold. I would think of it as an 80% collapse in the dollar.
Were you predicting that in 2011? Were you predicting $10,000 an ounce?
$10,000 an ounce?
Yeah, now that it's fallen 40%.
Yeah, I was predicting it, and I still am. I mean, it's history.
What's your time frame on that? 10,000.
Well, the thing is, it could start tomorrow. It could be about 3 years, Maria. But the point is, it could start tomorrow. We have an unstable financial system. I don't know when it's going to collapse, but the collapse is inevitable. That's the easy part. You can see that coming. The exact date, I don't know. I mean,
but when you preach fear to people, doesn't it encourage them to make bad decisions?
I think having insurance and protection, preserving your wealth is a good decision. It's a difference. You know, are you kind of greedy for income in the short run, or do you want to preserve wealth in the long run? You talk to, there's money in Europe. It's 800 years old. You know, the Colonna family in Rome, they've been around since the 13th century. And you talk to them, and I have. You say, how do you preserve wealth through the 30 Years' War, the Napoleonic Wars, Louis XIV, et cetera? They look at you, they go, a third, a third, a third. 1/3 land, 1/3 real estate, 1/3 gold. Have a little cash for your yacht and your helicopter and all that, but that's how they do it.
That's from somebody who started with wealth, though, rather than actually trying to create wealth.
They were all, you know, they were crusaders and fighters and warriors. That's how they got the wealth. But they did a good job of hanging on for 800 years.
And you look at gold as a hedge. Which we talked about this in the commercial break. I said I look at gold as a hedge, not necessarily as a commodity like I would look at copper. Is that right?
That's exactly.
You want to
right.
hedge against troubled markets.
Yeah, I think of it as money. If you want money, have some gold.
All right, stay with us, Jim. We want to get to oil as well because oil is extending its losses this morning, falling below $45 a barrel after tumbling nearly 8% yesterday. Phil Flynn watching all the action at the CME in Chicago. Phil, good morning to you.
Hey, good morning, Maria. We're seeing concerns about another increase in supplies here in the U.S., and there's a big report today at the Energy and Information Administration that's expected to see a build in crude supplies. But with all the volatility, there were some big stories in oil that hardly anybody's even talking about. We got a very important report from the Department of Energy yesterday that basically said that if we export crude, it will actually mean that gasoline prices may actually go lower. That's a big story in the press to lift if the ban on U.S. exports is growing, that's a very big story. The other big story is OPEC. Iran is bragging about how much oil that they can produce. They're trying to really send a message to the rest of the OPEC cartel that they better get ready for Iranian oil to come back into the market. There's a lot of talk about that today, and just trying to decide what OPEC is going to do as far as cutting production in the near future.
Okay, Phil, thank you so much. I'm just pulling up a quote yesterday from the oil minister of Iran, who says crude oil should be at $70 to $80 a barrel. That's fair. Is that fair?
No, crude oil will trade between 50 and 60 with overshoots. I understand it's lower than that right now, but 50 to 60 is the range. The reason is,
where do you get that number?
Saudi Arabia controls the price of oil. They have the lowest costs and the largest reserves. If you're
not controlling it now, are they?
Well, they can control it. They can basically reduce supply and get the price back up again, but they don't want it too high. They did a linear programming problem last year. They said, what price puts the frackers out of business but does not hurt our fiscal situation more?
That was the whole strategy, right?
Yeah, right. The answer is $60. Now, it doesn't mean you can stick the landing. Obviously, there are overshoots, but 50 to 60. It's going to take another year to bankrupt frackers, so I would expect that through the end of 2016.
Yeah, Dagan, you got to figure out what this guy is talking about. Iran says most OPEC members want oil at 70 to 80 a barrel. Well, no kidding.
Yeah, exactly. That sounds like the talk you get about the Iran nuclear program, right?
Right, but it's at 44 right now.
Right, and what Saudi Arabia did trying to gain market share and drive the price down, what they didn't realize, and Phil Flynn has talked about this, is that the fracking companies started producing more because they were indebted, and so they needed the revenue to try to make sure that they were making good on their debts. And so what happened was you wound up not with less supply, but a whole heck of a lot more supply, and that's one of the reasons that oil has collapsed.
Right,
was that the right strategy for the Saudis?
It is for Saudi Arabia. Sure, you want to put your competitors out of business. That's the right strategy for everyone. It's cutthroat, but that's temporary, Dagan, because the thing about fracked wells, they have a very short life. So yes, in the short run, they're pumping more to pay their bills. Longer run, they'll all go bankrupt, most of them.
Wow. That's a pretty big prediction there.
No, the BIS and FT, they've shown there's $5 trillion of junk debt and equities. Where did all this fracking come from? They had to raise money to drill it. There's $5 trillion of potentially bad debt out there.
This is exactly what we were just talking about, and that's going to be a knock-on effect for the broader economy in these markets. That's why I don't think that the trouble is over yet.
I agree completely.
Jim, good to have you on the show today. Thank you so much. Jim Rickards there joining us. We'll be watching.